Today, will the RBA blink first? Hello again, it's Martin North from Digital Finance Analytics, one that is post covering finance and property news. Well, on Melbourne Cup Day, we're going to get the next RBA cash rate decision. Michelle Bullocks' testimony before the Senate this week was actually pretty vague, waiting for data, will update forecasts, etc.
I was very interested, first and foremost, of your impressions of yesterday's quarterly CPI print. Obviously, there's a lot of economists that are speculating as to what that might mean, and I'm sure that there's an awful lot of mortgage holders out there holding their breath right now in anticipation of your testimony today. So perhaps you could expand on your impressions, immediate impressions of that data.
So they are immediate impressions. The print came out a little higher than we'd been forecasting at our August statement on monetary policy, but it was pretty much where we thought it would come out given the information we'd come into since then, particularly the monthly CPI indicator. So we thought it was going to be about where it came out. No surprises in the sense that some of the things that were important were fuel prices. We all know that fuel prices have been rising, so that wasn't a surprise. What we're observing is that a continuation of the trend that goods prices, inflation, that is still moderating, so that's still coming down. And we're seeing generally consumer durables, those sorts of things, prices for those, the inflation there is coming down. The thing that we've been saying for some time, and this particular CPI print reinforced that, was that services inflation generally is remaining fairly persistent. And the point with that is that when I say persistent, it means that the inflation in those sorts of components of the CPI tends to last longer. And this is a trend we've seen overseas as well, that while goods price inflation is easing quite a lot as supply issues unwind, consistently we're seeing that although services inflation is declining, it's still higher than we're comfortable with, and it's also reasonably persistent. So, in a sense, it reinforced all of that for us. What exactly this means, we've now got to take the information away. We've got to think about our own forecasts for that. We will be releasing a new set of forecasts after the board meeting in a couple of weeks' time in the statement on monetary policy, and there we'll have a reflection on what this might mean for our forecast. But that's my initial reactions.
But as Christopher Joye writes in the AFR, following the material upside surprise to inflation in the December quarter, almost all economists and investors agree that the Reserve Bank of Australia should lift interest rates in November. But participants worry that a concerted campaign to politically compromise Australia's central bank may result in the RBA remarkably choosing not to seek to combat its existential inflation crisis. In fact, this would be the latest in the chapter of accidents, with the RBA cutting rates too low and stoking the economy too much via the term funding facility and quantitative easing, and their yield control, of course, attempts went wrong, and then they held rates way too low, promising no hikes for years, and their forecasting is, well, frankly, a disaster. This is a central bank with a 4.1% cash rate that is just a smidge above what it assesses to be the neutral rate of 3.8%. And that is a cash rate that is 1 to 1.5 percentage points below peer rates in the US, Britain, Canada and New Zealand. Even the RBA's outgoing Assistant Governor Lucy Ellis, who is now Chief Economist at Westpac, called a hike only days after she predicted that inflation would not be robust enough to warrant one. Ellis concluded that we have seen enough for RBA's next move to be an increase. In August, the RBA expected that the trimmed mean rate of inflation would reach 3.9% over 2023, Ellis wrote. That seems a long way out of reach now. The December quarterly result would have a print at 0.5% for this to happen. Fuel inflation is stronger in the quarter, but so were vehicle price inflation, home building cost inflation, and inflation in a range of services components such as meals out and takeaway, dental fees, transport fares. Recreational services more broadly were also strong, and a significant fraction of the index saw quarterly changes moderating by less than expected. Along with strong services inflation more broadly, these outcomes suggest that domestic demand pressures are still driving domestic inflation. And Ellis also highlighted that brisk appreciation in house prices, which has confused Martin Place, combined with strong population growth, will buttress demand and will likely contribute to further anxiety. The RBA's preferred measure of core inflation, the trimmed mean, printed at 1.2% in the September quarter, compared with its official forecast around 0.9%. And the alternative weighted median core measure printed an even higher 1.3% due to the fact that it was less affected by government subsidies that dragged inflation down artificially. To make matters worse, the prior June quarter estimate of trimmed mean inflation was revised upward to 1%. Over the 12 months of September, core inflation has been running at 5.2% relative to the RBA's de facto 2.5% target and its 4.8% forecast in August. So on a 6-month annualised basis, core inflation has been 4.3%, which is about 0.7 percentage points above the RBA's inferred assumption of 3.6%. The RBA has focused on problems with persistently sticky services or demand-side inflation. These outcomes and estimated trajectory are both well above the RBA's current forecast profile that staff will update over the next week or so, said Kieran Davies, Coolabah's chief macro strategist. Now, make no mistake, this is domestic inflation, said Warren Hogan, chief economic advisor at Juno Bank, not global, not supply chain, not oil prices. These factors are secondary to the domestic inflation pulse, which seems to be running at around 4.5%. And Hogan notes that without various government subsidies, inflation would have been a lot higher. I have never seen so many policy interventions in one quarter, including energy, childcare and rents, he said. And this week we also received the September monthly CPI, as opposed to the quarter, which came out at a stonking 1.3%, excluding volatiles and travel for the third quarter. The concern is that there is no evidence of any deacceleration in inflation. In fact, the 3-month annualised rate of monthly inflation, excluding volatile items and travel, has accelerated to 5.2%, which is the fastest pace since the first quarter of 2023. Davies' modelling indicates that if one simply assumes that the September month inflation holds steady for the final quarter of 2023, annual core inflation in 2023 will end up at 4.5%, which is 0.6 percentage points above the RBA's official 3.9% projection. The RBA was hoping for a 0.9% and a 0.8% outcome for the final 2 quarters of 2023. So the 5.2% annual core inflation result represents the equal third largest error the central bank has made since it started forecasting underlying inflation in the early 1990s, according to Davis. The RBA's official projection was 4.8%. Based on the relationship between the current quarter forecast miss and the RBA's inflation outlook over the period from 2010 to 2023, the forecast error in the third quarter would ordinarily see the RBA raise both its year ahead and year and a half head forecasts for underlying inflation by about 0.2 percentage points. In the absence of a rate increase, this would compel the RBA to revise its forecast profile of underlying inflation in 2025 from 2.8 to 2.9% to 3.0 to 3.1% in the November Statement on Monetary Policy. But put differently, Australia's central bank would not be returning inflation to remotely close to the midpoint of its target band until all the way into 2026. Now, following the numbers, financial markets put an 80% probability on the RBA increasing its policy rate in November, and yet Treasurer Jim Chalmers and his appointed Treasury Secretary Stephen Kennedy were eager to spin a very different story. This is noteworthy because Chalmers has now just appointed Michelle Bullock as the new RBA governor after unceremoniously dismissing her predecessor, while Kennedy is a voting member of the RBA's board, the latter of which is actually very unusual vis-à-vis global peers. What we are seeing today in these numbers is consistent with expectations. It's consistent with the forecast that I put in the budget, the Treasury forecast, and it's also consistent with our expectation for inflation going forward, Chalmers said. And in an awkward attempt to directly jawbone Bullock, Chalmers asserted that the Reserve Bank looks for material change in the inflation outlook, what we've seen today, and they will obviously assess those numbers in their own way, but what we've seen today is consistent with our expectations. It doesn't materially change the inflation outlook going forward. Peak flying by there. And of course, it's worth noting that a material increase in inflation has been Bullock's key condition precedent for a hike. Columnist Terry McCrann claims that Kennedy all but announced that he'll be voting for a pause, and McCrann also pointed out that Chalmers has yet to appoint a deputy governor for the RBA, depriving Bullock of one supporting vote, and that the two new board members appointed by Chalmers do not look like rate hawks to me. And then there is the fact that Chalmers has still not executed the RBA's agreement with the government regarding the conduct of monetary policy. So it's all pretty unseemly stuff for a central bank that has had its credibility trashed. In sum, we know that the RBA should hike in November. Whether it actually does or not appears now to be a question of its ability to resist political interference, or in other words, how independent is the RBA really? And looking at everything to date, I have to say, not very. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.